Welcome everyone to the fourth of our financial planning workshops, and welcome also to those folks who are listening in on the webcast. These workshops are put on by the American Association of Individual Investors, sponsored by the AAII, the national organization. Some of you are familiar with it. We have a charter to help individual investors with unbiased education wherever we can. And we put on the monthly events here for the local chapter, and these workshops are really sponsored by them. Also sponsored by the Los Altos Library. We really appreciate their letting us use this room here for these. My name is Fred Smith. I'm a retired registered investment advisor and financial planner. I've given you my email address there. If anybody has any questions that they want to bring up after the workshop tonight, or at any point, any comments, any topics, and any feedback would be useful. Also, I've given you the website address for anybody who wants to sign up for the webcast. You can go to www.siliconvalleyai.org. There's a link there to sign up. And the slides for tonight and for the other webcasts and the workshops from the previous months are available at that website. This is the fourth of our series on workshops. The first three deal with investing, the fundamentals of investing, building a diversified portfolio, and then last month was computerized investing. And tonight we're sort of wrapping up the investing part of it with the active versus passive strategy trade-off. And it'll be interesting to see. I think most people have fairly strong feelings on where they stand on that, and we'll see how that stands up through the evening. Next three after this will be on retirement planning, and includes cash flow in retirement and also safe withdrawal rates. And all of these workshops are on the second Wednesday of each month. So the retirement planning will be January, February, March, and then April we'll do a workshop on Social Security and Medicare, and finally end up in May with estate planning. In the previous workshops, the first one dealt with the fundamentals of investing, and that one dealt with measuring risk and return. We looked at different methodologies for measuring the risk. It included the arithmetic mean and the geometric mean, the compound annual growth rate. Also internal rate of return, IRR. These were all discussed at that first workshop, along with the different measures of risk. Risk is really volatility, and it's usually measured mathematically using standard deviation. Also beta is one of the factors that are used for comparing the risk to a reference benchmark. We also then discussed risk-adjusted return, Sharpe ratio, Traynor ratio, and some other ratios at that first meeting to see how risk and return play together. Obviously, there is no free lunch, so the only way to higher returns is with higher risk, and anyone that tells you otherwise, if you get a cold call from somebody that tells you that you can get this great return at very, very little risk, at best, they're not very well up to speed. They're ignorant on the topic, or at worst, they're lying to you. But there is no free lunch there. At the first workshop, we also looked at various investment vehicles, stocks, bonds, individual stocks and bonds, mutual funds, ETFs, and so on. And we spent some time on our PIP, the personal investor profile. For the PIP, at that time I suggested everybody open an All About Me folder and you were putting documents in that to go along, and the PIP was the first document. You basically put your personal data into that along with your time horizon. While you're looking for funding a college education for some of the kids in 5, 6, 8, 10 years, or is it retirement that's farther out? Or even if you're retired at 65, you're probably still looking at a 30-year, 35-year horizon. So you shouldn't just assume that's going to be short. But all of that goes into the PIP. There'll be a risk tolerance questionnaire you should fill out if you go to Schwab or Vanguard, T. Rowe Price, whoever you use. They all have risk tolerance questionnaires, and that would be part of the PIP. And you should also include your tax status. If you're in a low bracket, that may indicate one set of investments. If you're in a higher bracket, you might be leaning otherwise. The second workshop that we looked at dealt with building a diversified portfolio. It's built on the first one. And we got into into a modern portfolio theory. A modern portfolio theory was put together initially back in, I think it was 1952, by Harry Markowitz. And I already mentioned that risk and return are related, and that they go together. But the thing that feeds into the modern portfolio theory is the third dimension of that. It's the correlation. It's how the assets play together with each other. And basically, modern portfolio theory describes how you can build a portfolio with the lowest risk, lowest volatility for a given level of return, or the highest return for a given level of risk. And so that was why we got into the diversified portfolios at that point, and how to build them up. We also looked at it as a range of different asset classes, fixed income and equities, international, some of the samples of those, and use those to build up diversified portfolios. At the end of that session, we then got into the second major document regarding investing, and that's the IPS, the Investment Policy Statement. And the IPS actually is where you should write down all of the stuff that goes into managing the portfolio. If you're going to an independent financial advisor, he would sit down with you and interview you for an hour or two, and you decide on a PIP at that point. And then he would probably work with you to agree on a strategy to be used in investing, and that would go into your investment policy statement. In which the IPS, the policy statement. What you probably do typically is list the asset classes that you've decided to use. You might say we're going to do fixed income and equities, which covers the whole board, as it were. You might decide you want to put, that based on your age and your time horizon and your risk tolerance and all that, you might decide to put 30% into the fixed income and to put 70% into the equities. And then for the equities, you might elect to split those further between large cap and small cap and domestic and international. And you also in the IPS you would write down, document whether you're going to use a passive strategy for doing your managing your portfolio, or whether you're going to use an active strategy. If you're going to be passive, you define how often you're going to rebalance, what triggers a rebalance. And if you're decide to do an active strategy for investing, you need to write down, the securities or the security classes you wanted to trade, and what the trading rules would be. Are you using an algorithm to decide when to get in, when to get out, and what triggers it, how often you look at it. All of that should be written down ahead of time, so that if the market drops 10, 15, 20% over a weekend, you don't panic on Monday morning and do something stupid. What you should do is pull out your IPS and say, well, what did I decide, months ago, years ago, in a nice, quiet, calm time that I should do under circumstances like this. So typically the PIP would only be half a page or something. I'm not talking about a huge document. And the policy statement is probably a page or two, but it should be enough to define for yourself what the strategy is that you want to use for your investing and probably why. You can think of it as the document you would want to give to your agent if you were disabled. I don't want to be pessimistic here, but if for any reason you weren't able to manage your own account and somebody had to step in with power of attorney to manage it for you, they should ask you right off, well, what am I doing here? How have you been investing here? How do you want me to continue this? And that document should be a written document that tells them, that describes for them how you've been doing it yourself, and lets them know what they should do, in your place. Last month, Al Zablosky filled in for me because I wasn't here, and he covered the computerized investing, and an introduction to CI, and he covered a whole bunch of different tools that were available mostly for those that wanted to go the active investing route. He looked at the top websites that were available. He looked at the resources that are available at the library here. Does everybody here, by the way, own a Santa Clara County Library card? The rest of you need to get one, because they're free. All you got to do is show up at the desk and request it and fill it out. But if you have a Santa Clara County Library card, it gives you immediate access online to 2 or 3 great websites. The first one is Morningstar. Just having the library card allows you to log into the Morningstar website just for the asking, no charge. There's a whole ton of useful information there. It also has S&P website, and it has a Value Line website. And they're all there, just from your computer anytime you want. But you do need to have a library card to get them for free. If you don't have a library card, you could literally pay hundreds of dollars a year for access to these. Al also looked at other freeware investing tools, and he finished up, I think, with a session on robo-advisors. All of this is available on our website on the AAII.org, Silicon Valley AAII.org. All the slides are available if anybody wants to go back and revisit any of that. Any questions so far? Okay, we're going to wake up a little later because this is a topic that's going to. May have to avoid a food fight later on when we get into the details of it. Oh, okay. Back here has to do with getting turn off our video. That's what that whole video up there. So we're trying to get, but I can't hear what you're saying. Okay. Is there anything I can tell people on the webcast that they need to turn off? Turn off the video, folks, please. Those of you who are listening in on the webcast, we're having some interference here. Thank you. Okay, so today we're going to cover a number of topics. So the first thing we're going to be looking at is the efficient market hypothesis, and we're going to go into that in some detail. We're going to look at the CAPM, the capital asset pricing model. We're going to look at various rules for active and passive investing strategy and what the differences are. And finally, I want to challenge you folks to give you enough information to decide which side you're on. Most people probably have fairly strong feelings as to whether they're passive investors or active investors, and probably nothing I say tonight is going to change that. However, I want to at least make you go home and think about it. So that's the agenda for tonight. That's interesting. I can't advance my slides. Okay, thank you. We're back in the air again. The efficient market hypothesis was developed in the 1960s by Eugene Fama. Fama did a ton of work, along with Sharp and Harry Markowitz and a whole bunch of folks back then. I think they were mostly out of the Chicago school. But what Fama basically published then was that he asserted that all asset prices fully reflect the data available at each and every point in time. In other words, stocks always trade at their fair value, whatever that means. That's a pretty sweeping statement, and it looks innocent enough up here, but if you look at the implications of it, it gets a little hairier, a little trickier. There are actually three forms of the efficient market hypothesis. There's the weak form, which says that all information in past trading history is already factored in. And if that's the case, technical analysis can't provide any excess return. You're wasting your time doing technical analysis. The semi-strong form says that prices adjust rapidly to the release of new information. As new information comes out, the prices almost immediately switch to incorporate that. And what that means is that you're wasting your time doing fundamental analysis. And finally, I love this one, the strong form, even including insider information, doesn't give you, I mean, it's totally illegal, doesn't give you an edge, because even insider information, illegal as it is, gets around pretty fast, and the prices will have adjusted to take care of that. So what the bottom line is that it's impossible to achieve excess returns consistently for any of these. The efficient market adjusts the prices based on whatever data is out there from whatever source it is, and you're wasting your time trying to beat it. Yes, sir. Question says, what do I mean by excess returns? I mean returns beyond what the market can provide for that level of risk. In other words, beating the market. It's not possible to beat the market. That's what Fama's hypothesis says. Here are the implications, and I know that this is going to wake up some folks, because I suspect that half the people, well, let me correct that, 90% of the people in the room won't agree with this. But this is what Fama said. If the efficient market hypothesis is valid, here are the implications. It's impossible to beat the market through expert stock selection or market timing. You're wasting your time on evenings or weekends or giving up fishing or whatever it is you're doing. You're wasting your time because it's impossible to beat the market. He says that research is a waste of time and resources. Don't even bother. He says that a broad portfolio, I love this one, a broad portfolio picked by trained monkeys is likely to perform as well as the expert selections. The analogy that folks use, that you train monkeys to throw darts at the stock page of the Wall Street Journal and go build a portfolio based on that. And if you have enough monkeys throwing enough darts, on average they'll do just as well as the experts. The only path to get higher returns is to take higher risk. So this goes way back to our first workshop. They were talking about risk and return are tied together, and there's no way of getting higher returns without taking more risk. And I can hear everybody go, but. Warren Buffett's the first thing that the folks throw up. They say, Buffett, if you look at the last 36 years of Buffett's record from 1980 through to the present, November 2016, the end of November, just gone. Buffett had a 19.2% per annum compound annual growth rate. That's pretty darn good, and that doesn't seem to smack of an efficient market anymore. He seems to have found a way around that. Buffett is obviously a smart guy, and he doesn't mind doing a lot of work. And for an older gentleman, he still does a lot of work. But 19.2% over a 36-year period can get your attention. The other thing you hear is, well, what about Peter Lynch, who managed Fidelity Magellan for years and years and years, 1977 through 1980? He had a 29% compound annual growth rate. He must have found some way around the efficient market. Bill Miller managed the Legg Mason Value Trust between 1991 and 2005. There's 15 straight years where he beat the S&P 500. That has to count for something. We had the market crash in 1987, October 29, 1987. I'm sure everybody remembers that one, where the Dow Jones fell by over 20% one day. It's hard to explain anything that changed on the external circumstance, any new data that would have come in the morning of October the 29th, or the prior evening, that would suddenly trigger a 20% crash. So again, it doesn't sound too much like an efficient market. We had the internet bubble, 2000, 2001, well, it started in 1999, and 2000, 2001, 2002. Major bear market then. And then in 2008, we had another big crash. So all of these seem to indicate that the efficient market is not all that Fama thought it was. It seems to fall apart at times. When you look into the details, there's some element of truth to that, but there's also some circumstances that mean that maybe there might be more to the efficient market than we're giving it credit for. When you look at Buffett's record, his early record, he was getting 25, 30, over 30% per annum for the early years. But if you look at the last 20 years, from 1996 to 2016, that's a fairly extended period of time. He had just over a 10% per annum compound annual growth rate. For the last 10 years, it was only 8.1%. Those are the numbers that you and I can get any day of the week with a passive strategy. I think one of the keys here is that the best part of Buffett's record he earned in the pre-internet days, when data was much more difficult to obtain, and you could not obtain it on a timely basis. Since the internet has become popular, it's like drinking from a fire hose. They say that there's more data than you can handle, and it's available in nanoseconds. So it's leveled the playing field a lot. Peter Lynch's record goes back to the pre-internet days. Again, Lynch had all sorts of invest in what you know, and various maxims that he followed, and he was highly successful with what he did. But there's some doubt as to whether a new Peter Lynch could duplicate that same record today in today's data-rich environment. When we get to Bill Miller, it's a little different. I'm not saying that Miller was stupid. He wasn't. He was a very sharp man, but I think he was lucky, and it's surprisingly difficult to separate skill from luck. You might think that if somebody had a 5-year record that was pretty darn good, that you could prove from that he had he was very skillful. But the reality is, 5 years is a very short period of time. Even 10 or 15 years, you can be lucky for 10 or 15 years in a row. If you look at the odds of beating the S&P 500, if you had enough shots, enough people doing it, again, you can go back to your trained monkeys if you want to. If there's enough people taking a shot at it, their average is going to come out of the market return, but that means that half of them are going to beat the market and half of them are going to fall short. And what that means is that in any one year, there's a 50-50 chance that they'll be above the market, or 50-50 chance, a 1 in 2 chance above, or 1 in 2 chance below. So to beat it for 15 straight years is 1 in 2 to the 15th, which is 1 in 32,700 and change, 1 in 33,000. Those are pretty long odds, to beat the market for 15 straight years just on luck alone. On the other hand, if you have 1 million investors out there, or 10 million, well, I should say 1 million investors, just to keep the numbers easy, you're going to have 30 of that million people who would just on luck alone could beat the market for 15 straight years. So again, I'm not saying that Bill Miller didn't earn it. He certainly had a lot of skill, but he also had a lot of luck. And Miller himself admitted as much. He basically said that his record was an accident of the counter. He was being lucky. Those were his own words. So even beating the S&P 500 for 15 straight years doesn't, in and of itself, rule out the possibility that the efficient market hypothesis doesn't, in fact, contribute something useful. All of these theories have limits. I'm not saying that they always hold all the time. Modern portfolio theory in particular relies on assumptions which are not always accurate, and the biggest one is that investors are rational beings. None of this is rational when we get on the computer and start making trades with Schwab or whatever. Emotions take over, and you do things that in the spur of the moment that aren't necessarily logical. So the assumption that investors are rational beings is frankly highly questionable. But these things work most of the time, but they do fail. I talked about the 2000, 2001, etc. Crash back then. We talked about 2008. Sometimes emotions take over, and they have a way of feeding on themselves, and things get out of control, and it's not logical, and the theories fall apart because the people are not acting logically. I think of this as akin to what Einstein did to Newton's law of gravity. Newton's law of gravity was around for what, 350 years. Basically apples have been falling downwards from trees for at least 350 years that we're all comfortable with, and it works just fine. But 100 years ago, in 1906, I think it was Einstein's special theory of relativity, and then 1916, his special theory basically said Newton's law of gravity work a lot of times, but there are places where it doesn't work. There are special circumstances where it does not apply, and those special circumstances happen to be if you're traveling very fast, close to the speed of light. And everything Einstein put together then has been proven since, and it's valid, but it still doesn't negate the value of Newton's laws. I mean, for most of us here that are earthbound and have no notion of traveling at the speed of light or anywhere close to it, Newton's laws do just fine. And today, apples still fall downwards from trees, and we're all comfortable with that. In the same way, I think, the modern portfolio theory and the efficient market hypothesis, there are places where it doesn't work. There are special circumstances when it gets away from us a little bit, and it's not, you can't rely on it 100% all the time. But on the other hand, if you behave like you do trust it totally, if you act like you're a believer, it will keep you from making any serious mistakes. It's the same thing as saying, Newton's good enough for me. Apples are going to fall down. If you act like modern portfolio theory and the efficient market are meaningful for you, I think you'll find that it keeps you out of trouble a lot of the time. In the other corner of the market where people act irrationally, there's a whole new science coming up. Well, it's not all that new now anymore, but behavioral finance tries to cover those areas where investors are known to be making irrational decisions, where our behavior is irrational, illogical, and we're making cognitive errors. And they're trying to define a science around irrational humans goes a little beyond what I'm prepared to get into tonight. I'm not sure that it can be done. I mean, by its very nature, people are going to be unpredictable when they become irrational, and but fortunately, that's only one small corner of the investing world out there, and I'm prepared to ignore it. Any questions? Anything out there so far that strikes folks as that they want to argue with me on?
Not argue, but have there been any serious attempts to try to validate the fear? Are there ways to try to measure whether that
the question is whether there have been any serious attempts to validate these theories or to measure whether they are in fact true. I think you'll find that over the last 5-6 decades, if you look at what's actually happening in the market, most folks will say that I can't give you exact figures and results, but the reality seems to track the theory pretty well. The fact is that if you were, passive portfolios are built almost totally on modern portfolio theory. The reality is, in practice, passive portfolios on a long-term basis outperform most active strategies. It's very, very difficult. And trust me, I put in far more time on a computer than I really want comfortable admitting to trying to beat passive strategies. And I've failed so far, and there are a number of gentlemen at the back who are doing it as well. The reality is, in practice, it's very tough to beat on a long-term basis. You'll always find for 5 years, for 10 years, or whatever, there may be a strategy that works just fine, and then it stops working. You need to recognize when I use the expression long-term, I'm really talking about long-term. I'm talking about probably 15 years minimum, maybe 20 out. As I just showed a few minutes ago, luck alone can pull the data for 5, 10, or even 15 years. You need to go beyond 15 years to get to the point where you can prove that it's not just luck. I want to talk for a minute about the capital asset pricing model. This was developed by Harry Markowitz back in the 1950s. Bill Sharp was one of the guys who was around then, still is around, and he's contributed significantly to it as well. In its very simple form, what we're saying is that the expected return on a portfolio is equal to alpha plus beta times the market return. Alpha defined as, again, back to the notion of excess return, above an appropriate risk-adjusted benchmark, the benchmark for that market return. And alpha is usually used to measure the performance of a fund manager. If you have an active fund manager who claims to be able to beat the market, for a certain level of risk, this is his way of proving it. You ask, what's your alpha? And the alpha will vary year to year. Hopefully, he wouldn't be doing this unless he thought that most of the time he could have a positive alpha and give you an expected return above what the risk-adjusted market would give you. But the act of trying for that positive alpha means that from time to time, frankly, he will fail and he'll be loath to admit that he has a negative alpha. And we're going to go into those in a little more detail in a few minutes. The beta is just a multiplier for the market return. It takes the risk into account. The beta of 1 means it has the same volatility as the market. Something that's got a beta lower than 1, maybe 0.7, 0.8 or something like that, would be less volatile than the market. That might, for example, be a portfolio of dividend stocks or something like that might not move around quite as much as the overall market. A beta of 1.1, 1.2, 1.5, above, higher than 1, it means that's more volatile than the market. And you might be looking at a portfolio of small cap stocks or looking for extreme growth and this kind of thing. So what the capital asset pricing model really does is give you that linear relationship where it separates out the alpha and the beta. And that's where those terms come from. You've probably heard them in all the trade press and so on. Okay, so we're going to start building up some simple little models for passive investors and active investors. I'm making my own definitions here, and they're very simplistic definitions, but I'm using them to make a point which will develop as we go through it. I'm saying that a passive investor is anyone who attempts to replicate the market at the minimum cost. He wants to get the market return, and he wants to pay as little as possible for that, because whatever his costs are gets subtracted out from his market return. And what that really means is that that's somebody who's comfortable realizing just the market beta. He's not trying to beat the market. You're going to love this one. An active investor is anyone who's not a passive investor. It's the rest of the world. So if you're not a passive investor, based on my definition here, then by definition you're an active investor no matter how you differ from it. And there are dozens, thousands of different ways to be different. An active investor obviously attempts to beat the market. It's somebody who aims to generate excess returns, in other words, positive alpha, above the market return. And the act of trying for positive alpha means that frankly, every once in a while he'll fall short and come up with the negative alpha. But those are the definitions. A passive investor is anybody who wants to replicate the market at minimum cost and an active investor is everybody else. The comment is that it seems to be possible to be both an active and passive investor at the same time, and perhaps with different portions of portfolio that you treat differently. Absolutely. I mean, first of all, you may be a little, what's a nice way of putting it? You might be able to switch hit both ways, in your mind without bending your mind too much. But the notion of having two separate portfolios and managing them each separately, differently, is perfectly feasible. And in fact, that's one of the things we're going to be discussing at the end, with a sort of a core and explore approach, where you do a passive for the core, and then you look at satellites that might be managed actively around the periphery. So yes, it is possible to do both, but you want to be very clear for each portfolio who you are and what you are, and therefore you need to write it in your PIP and your IPS. You may need a separate IPS for different portfolios. If you have a portfolio that you're managing for college education in 5 years, that might need to be done totally differently to a retirement portfolio for 30 years out. Questions over?
Where do the risk-adjusted benchmarks that are applied in calculating the alpha, where do those come from?
The question is, where do the risk-adjusted numbers come from for the benchmarks? I can't think of any one source where you can get everything nice in one clean source, but if again you go to some of the websites like Morningstar or I guess S&P, any of those, Morningstar in particular I know a little bit more about. They will give you the Sharpe ratios for the different funds, and that's risk adjusted returns. Most of the websites will give it to you in one form or another. They may not all be totally consistent. We talked about passive investors and active investors, and I want to address here is what kind of investments they get into, typically on each side of the fence. Passive investors, by definition, are going to build a diversified portfolio of low-cost index funds and rebalance diligently, which is exactly the model that we discussed back in the workshop 2, building a diversified portfolio. You want to make sure you're not confusing passive investing with a buy and hold strategy. The rebalancing is really a critical part of it. If you just do a buy and hold and never rebalance, that is an inferior strategy in my mind. I think it would be beaten all the time on a risk-adjusted basis by a buy and rebalance strategy. The problem is if you just buy and hold, you may have set it up that you wanted 60% equities and 40% fixed income today. You might have looked at your PIP and your IPS and decided that's where you wanted to be. And for a couple of years, that's great. But over a long-term basis, the equities are going to outperform the fixed income. You're going to wind up with a 70-30 or an 80-20 balance in your portfolio. In other words, it's going to get out of balance. And having more equities in there means you're going to have higher volatility down the road, and you're going to have a bigger risk. That if a market correction does occur, it's going to wallop you more than if you had rebalanced beforehand and gotten back to your strategic value of 60-40 or whatever it was. So don't think of buy and hold as being the goal here. The goal is buy and rebalance. Active investors, on the other hand, fall into a number of groups. You got the stock pickers who figure they can identify stocks that are going to perform better in the future. And in order to convince yourself of that, you really, really either consciously or subconsciously need to kind of think that you know more, that you know something that the rest of the market doesn't know. The rest of the market knows about it already, then it's already priced into the stock, and you need to convince yourself that you know better or know more or have better information to make that decision. The same argument goes for the folks who are trying to time the market. And normally you do this to try to avoid the big drawdowns. 2008 was really, really painful for everybody. And there may be a few folks, in fact I know some folks who've seen it come in and gotten out in time, but a lot of those folks are still waiting for a signal to get back in again, and that's not a good way to go either. Again, you have to make the argument that you know better than the market as a whole, what's going to happen, and to make that prediction. Momentum players usually buy stocks that are going up, and they figure it's gone up for the past 1, 2, 3, 5 years. It's going to go up for the next year or two, so I'm going to buy into it. You're buying it, rising value, and hoping that's going to continue to rise, and that you can sell at a higher point. Contrarians, on the other hand, work the other way around. They figure, well, such and such a stock lost 20% in the last few months. It must be great value now because it's basically a good stock. I'm going to buy in now and wait for it to recover, and hope to be able to sell, later after a good recovery. All of these really amount to arguments that you know better or you know more than the market does, and you're placing a bet, on that assumption. If you're correct, then you can be a hero. If you're incorrect, you can be a goat. Okay, for the market as a whole, it turns out in practice that 70% of the market are trading, are active traders. They're following an active strategy, and only 30% of the market. These numbers aren't absolute. This is 2 or 3 year old data, but it doesn't change a whole lot. 30% of the market follows the passive strategy. I think the passive sector there is actually growing, with time. Each year it increases a little bit. So it may have gone up a little bit since I got this data. But that's roughly the spread. It's roughly 1/3, 2/3. Yes. Good question. I believe it's the total dollars, the total dollar value of the market that's traded. So that will include all the big guys, the pension funds and the mutual funds and ETFs and all of that as well. Maybe now is as good a time as any. If you think about it, 70% is a fairly large number for the active traders, but how do I put this again gently? All of the professional managers out there almost have to be active traders. You can't take somebody's portfolio and promise to manage it for them, be it a pension fund or even an individual financial advisor, and say you're going to manage it for them, and you're going to ask them for 0.7%, 1%, 1.2% per annum, or whatever, and have them come back the next year, and you tell them, don't change anything, but it'll be another 1.2%. People aren't going to go for that. It's the same thing with the financial magazines. They come out month after month after month, and they can't give you long-term results that change painfully slow, like watching paint dry or grass grow or something like that. Each month they have to come out with something new and some new gimmick, and just to stay alive, they have to take different viewpoints in the market and give you a different approach, a different attack. And they go out of business for repeating the same old stuff, month after month in a boring fashion. Do you have another question?
Yeah, so would passive include funds that follow market index?
Yes, passive will be, the way I defined it earlier, it'll be a diversified portfolio of index funds, market index funds, usually or of necessity at the lowest possible cost. Now they will tend to be low cost anyway, but the passive guys key off the cost because that's an important parameter for them. The active guys ought to be doing that, but in general they think that their expertise is going to let them live with a little higher cost and that they'll make it up in better returns and stuff like that. Passive guys are very clearly tuned into cost. Okay, so let's look at, we're going to build up a model here, rather crude model, but it's fun. I think it shows some of the principles involved here. We're going to say that first of all, passive investors get the market return by definition. they're doing their best to replicate the market, and they're going to get the market return less a little bit for costs. If you go back over 20 or 30 years, the long-term market return, I haven't even defined market here. I mean, it could be the S&P 500, it could be the large cap, the small, whatever. We're just building a model here so I can pull numbers out of the air, and I want them to be somewhat realistic, but the exact value doesn't matter. So I'm assuming that the market return is 10% per annum, a nice round number. Assuming that for the passive guys, they're using index funds, and that the costs are 0.25%, 250 basis points for the cost, the expense ratio. In reality, today, a lot of the index funds or ETFs are trading even below 0.1%. I recently saw a list of some of the major standard index ETFs that were down as low as 3, 4, 5 basis points, which is very, I mean, they're almost down to zero. They'll never actually quite go to zero, I think, but they're very, very close to zero. I was in one of the financial magazines, I saw the list, but in essence, all the major players, and I mean, Schwab and Vanguard and iShares are the ones that are driving it. If you look at just a simple large cap fund, either a blend or a growth or something like that, almost all of those are certainly below 10 basis points, and some of them are below 5. You don't have to have an inside track or anything. This is just go on Schwab or whatever your favorite financial house is and look at. I'm talking about the standard ones. If you want to go international or emerging markets or something, then they'll be more expensive. But the simple bread and butter S&P 500 type stuff shows they're all running below 10 basis points now. All the passive investors are aiming for the same target. So they're trying to keep the tracking error down, the difference between their actual results and what the index is making, but they're all aiming for that same market return, and therefore the distribution is going to be very narrow. If you look at 100 passive guys all aiming for the same target, the same bullseye on the dartboard, as it were, they're all going to be clustered around that point, and they're going to be clustered fairly tightly.
So if you're using the 10% are you saying that passive investors are aiming for that?
No. What I'm saying is passive investors are aiming for the market return. The market return over time, over a long period of time, averages 10%. And any one year it could be 15 or 25 or -5 or whatever. You'll get the market return. But I'm just saying that for the sake of building up a model to demonstrate what we're looking at, I've assumed that for purposes here that we're looking at 1 year with a 10% return.
So, but then you say the distribution is very narrow. I'm not sure I understand.
The distribution in that year is very narrow. If the market return for 2016 was 10%, all passive investors for that market are going to get real close to that 10%. If 2017 turns out to be -5%, which it could do, we'll all be around that -5 real close. The only reason, besides the cost, that you get any distribution at all around the market return is because not all passive investors are going to invest in the full market. If you take the S&P 500, for example, one way to replicate it with no tracking error at all is to buy all 500 stocks in the proportion of the index. And that's an expensive thing to do. And then next year, when you have to rebalance, you got a bunch of trades to make, and it may cost you a bunch, to do the rebalancing. So what a lot of passive investors will do will maybe buy the 50 largest growth stocks in the S&P 500 by the 50 largest value, and so with 100 stocks, they would argue it's not going to track perfectly, but it's going to be pretty darn close to the S&P 500. And it's a lot cheaper to trade. So there'll be some slight distribution based on the different tweaks that people use to try to replicate the the S&P 500, or whatever the index is that you're talking about. I'm just using as an example here. So this is what it might look like in a year where the market happened to be 10%. And what I'm showing here is, let's see if I can, yeah, I can do this. This black one here, does that show up on here? Yeah, it does. This black is the market return sitting at 10%. The green is a narrow distribution around that, and you can see at the top, that the peak of the passive distribution is a little below the market return. That represents the 250 basis point cost of doing it. So you got a tight distribution that's a tad below the market. It's interesting to note here, this is just in passing, that, here we go, even the passive guys, a few of them might look out and might actually beat the market. This is more accidental. Where's my, there we go. There'll be a finite number that might just happen to beat the market because whatever sampling technique they were using might be such that they lucked out. They'd be the first to admit there was only luck, that 50 or 100 stocks that they picked as a sample out of the 500 actually did better than the 500 as a whole, and they may have done better by more than the cost. So the upper tail could conceivably be above the market, but that's only incidental. That's just a lucky happenstance. I mean, that's certainly not what they were aiming for. What they were aiming for was being in the middle of that green distribution, and they expected to make the market return less some minimal costs. So now let's look at the active guys. The active investors plus the passive investors make up the total market. So if the passive investors are making the market return, less costs, then the active investors, on average, in aggregate, must also make the market return, less costs. I mean, if you look at the top equation, and you got the market on one side, and you got the passive investors, and if they're both equal to the market return, then the active guys have to be equal to the market return on average too. So we give them the same 10% per annum assumption as the passive guys, which is assume that the market's doing 10% per annum, and that on average, the active guys are going to make the same 10% per annum less their costs. But the costs for the active guys are going to be very different to the passive guys, and the distribution is going to be very different for the active guys. So we need to look at both of those carefully. For the active investors, in general, the costs are going to be higher. They're going to be higher because somebody has to pay for the research done. Unless they are literally throwing free darts at the board and doing it that way. I mean, if they're doing any research, they're paying for the research in one way or another. And if this is part of a mutual fund or part of a pension fund or something like that, it could well be a team of folks. In fact, some very highly expensive MBAs and PhDs, economic PhDs or whatever in there that don't come for free. They're all doing their work to try to decide what the optimum strategy is. Somebody's going to have to pay for all that. Active investors tend to trade more often, usually hopefully with other active investors, and they're going to incur higher transaction costs. The funds that the active guys invest in, or I should say the funds, the equity, securities in general, whether they be funds or individual stocks or whatever, will tend to be a thinner market than the index funds, the standard index funds that the passive investors use, and therefore the active investors will incur a higher bid-ask spread. The difference between what you pay on the Schwab website if you're buying or if you're selling. Usually these thinner markets also incur a higher expense ratio. I've shown what the real extreme case here are hedge funds. They're probably the ultimate in active investing. Typically charge 2% per annum as an expense ratio plus 20% of the profit. That's a big nut to overcome. I mean, you better get a really good return, excess return to justify that. John Bogle, the founder of, one of the founders of Vanguard, has calculated that the all-in extra expense or investment expense for an active fund is 2.27%. He just dumped everything into that one number. Just for keeping things nice and simple here, I'm using a number of 2% per annum for the total cost. The distributions for the active investors are going to be wildly different to the passive investors. Don't forget, for the passive investors, they're all aiming for the same bullseye, the same target. The active guys are aiming here, they're aiming here, they're aiming all over the map. So you're going to, by definition, get a much, much wider spread. They're not aiming for the same target. Some will be aiming, thinking that they're in a growth environment and that growth stocks is the way to go. Others may figure, well, I'm into value investing. I'm going to target the value funds. In any given year, if the growth has done well, chances are the value hasn't, and vice versa. You may get some aiming for high dividend stocks or low price to book, blah, 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 whatever the magic formula is. You may get some that are playing the momentum game, betting that whatever's been rising in the past will continue to rise. You may get some contrarians. And again, if one's done well, chances are the other hasn't. So you've got this whole range of different strategies that are going to give you a whole range of different results. The other reason why you get a wide distribution in general for the active investors is because by definition they have to go with a concentrated portfolio. You can't be an active investor, at least not professionally, and diversify all over the place, because your clients are going to say, hey, I can get a diversified fund for 0.1%. Why should I pay you 1% for the same thing? In fact, it's a real stigma for the professional active investors to be targeted with the slur of calling them a closet indexer. If they're going to index, they better be charging indexing prices, and the only way that they can get away with charging the higher prices is to place bigger bets on a narrower and narrower segment of the market. So again, that's going to lead to volatility and to a broad distribution. So putting all this together, we have the same market return at 10%, but the red curve shows a possible distribution, and I'm not saying that the numbers on here are all that meaningful. I just want to show a wide distribution. I'm arguing that if somebody was betting on growth stocks, for example, I keep losing my little arrow. Here we go. If somebody was betting on growth stocks heavily, and growth stocks happen to do well, he may well end up out here somewhere and be a real hero. But for every guy that's betting on growth stocks, there's somebody else that's lost out badly because he thought value was going to do well and it didn't, or any other parameters that you want to pick. So basically, for every hero on here that's done really well, there's a goat on the other side of the equation. So what happens? Oh, I've already advanced. Okay, if you lay the one on top of the other, you can see that you have a choice of being a passive investor and getting a near certain return of the market with a tight distribution wherever the market happens to be. And in this case, we've assumed for this year it's 10%. Or do you want to take a chance and go for the red curve, knowing that sometimes you'll be a hero and you'll do well, out here, but sometimes you'll guess wrong and you'll wind up down here. So every time you deviate from being a passive investor, you're betting on your ability to beat the market, but you got to know for a fact that you're also opening yourself up to the possibility of falling short. No guarantees. Now here we get into some of the trading issues. Since active investors get the market return before costs, half of the active investors will beat the market and half will do worse. Just simple math. And for every trade that an active investor makes, either he will prove to be a hero, a winner, and will have beaten the market, and the guy on the other side of that trade will be a loser because he picked the wrong side to be on for that trade, or vice versa. You don't know at the time you're making the trade whether you're a hero or a ghost, but you're going to get tagged with it. Time will prove that you're one or the other. Is everybody here familiar with Garrison Keillor and Lake Wobegon, where I think it's all the women are strong, the men are good looking, and all the children are above average? That doesn't apply here. You can't have all of the you can't have all investors above average. I've said here active investors. Can't all be above average. So for every trade that you make, you need to ask yourself, do I have an advantage over the guy on the other side of the trade? Am I smarter than he is? Do I have better data than he has? Do I have better resources, a deeper pool of people, CFAs or whatever, working on this? Or like Clint Eastwood and his Dirty Harry, am I feeling lucky today? But when you make a trade on the active side, you may not consciously ask yourself these things, but there are things that are there in the background that you really should be asking. And you shouldn't be making the trade unless you can get some positive answers to these. You better be feeling lucky, or better feel that that you're smarter than the other guy or whatever. If you look at both sides of the trade, let's just say you're on one side, so the question comes up, who's on the other side? It could be a pension fund, CalPERS or somebody. It could be one of the university endowment plans that making some buys. It could be mutual funds, ETFs, whatever. It could be individual investors. Individual investors I've split into the smart ones. And I really didn't want to call anybody dumb, but I just said smart and not so smart. So that about covers the full market of folks making the trades. Chances are that you could well be in an asymmetric risk, information risk. If you have an institutional guy on the other end of the trade, the probability is that he knows something you don't. He's got better resources in general than most of us do, and he's probably got a better reason for his side of the trade than you have for yours. It's not always the case, but just keep in mind who's on the other side and what do I think I know that he doesn't. What's the probability of your trade proving to be the right one? If you're making a trade, you really don't want to think of the guy on the other end as being, a pension fund manager or somebody with a whole department, a whole army of CFAs cranking out numbers for him. You really don't want to think of the guy on the other side of the trade as being an individual investor who's smarter than you are. The only guy that you really want on the other side of your trade is one of the not so smart guys. So the question really comes, are there enough not so smart guys to go around? I don't know. Was it Warren Buffett or somebody who said that if you're playing poker for 20 minutes and you haven't figured out who the goat is, it's you. Okay. Any questions? No, I'm not. No, I'm not going to stand up here and make the point that financial advisors know more than the individuals do. I don't know that that's necessarily true. I would make the point that I did earlier, repeated, that financial advisors, it's easy for me to say this because I'm retired. Maybe that's the only reason I can't. Financial advisors in general have a conflict of interest in that they have the incentive to pretend that they know more than you do. They may or they may not, but if they're going to charge you 1%, they can't come into you and say, I'm as dumb as you are, but here's what you should do anyway. You know, they have to take the position, and there's nothing. I mean, I'm not saying that they're misleading you or anything in any way, but you know, they need to believe in a strategy that they can beat the market, and most of them will explain to you what their strategy is, why they think that they will beat the market. But unless they can do that, they really can't come to you with a straight face and ask for enough of a fee to put their kids through college. Or to put bread on the table. I mean, it's a living for them. They've got to do it. There's data out there that shows that most traders trade too often. And in fact, there's one study where I think it was Schwab made some data available, some trading data available to some research folks in 78,000 accounts. And they hid all the private names and social security number, all the sensitive data, but they made the trade data available. And the research showed that on average, those folks that made a trade would be better a year off if they'd never made that trade. That the stock that or equity that they sold did better than the one they bought. So they'd be better off not to have done it. Are folks familiar with Mark Hulbert? You know who I mean? He's a financial journalist out there. He's fairly well known in the industry. Very good speaker. We've had him at the AII at the national conference a few times. I heard him. Oh, this is years ago. This was back when, in order to make a trade, you needed to pick up the phone and call Schwab. You know, it was before everything was automated online. And Hulbert was saying that he missed a golden business opportunity. He should have gone into business selling stickers to go on your phone with the Schwab number on it and saying, if you're thinking of calling this number, don't. I should think, we'll be having Mark Hulbert speak to us. I think it's in April, second Saturday in April. He'll be speaking to us at our monthly event at the AMC Theater. Go online to the website, you'll see the details for it. So we have what I think of as a paradox. If a passive strategy does all this for you, if you go to it's low cost and gives you the market return and does it efficiently, why would anybody do anything else? Why not just accept a free ride? The problem is if everybody accepts a free ride and adopts a passive strategy, there's nobody left to do any security analysis, nobody left to make sure that the market is efficient. So the message to the active investors is, keep up the good work, guys. We need you. We need you to continue doing your analysis, trading amongst yourselves, and keeping the market efficient. Yes, we have a question.
Got a question from the web. One person asked, well, how about sector investment? Okay. In some sense, you know, it's passive, and not what sort of sector would you buy. The individual says healthcare has done long term really well. Why not, does this apply to sector investing? Why not do sector investing?
Okay, the question relates from the web. It relates to sector investing, sector rotation strategy, and the comment was that healthcare has done really well for the past few years. You know, why not stick with that? And you know, does this apply to sector investing? What I've said applies to any. I haven't so far defined the market that I'm talking about. You know, all the examples that I've done, I've basically used the S&P 500 as as an example. If you wanted to split the market into the 10 sectors or whatever they normally split it into, and keep you can get an index. You can in fact get an index fund for each of those sectors. To the best of my knowledge, I'm not sure that it's the cheapest one you can get, but you know, you can get them at a reasonable price. And if your IPS allocates a certain percentage to each sector and you rebalance on an annual basis or whatever, yes, you could do this, you know, for that. I'm not sure that it's necessarily the optimum way to go, but it's certainly a way. But you should spell it out in your investment policy statement. Okay, I love this chart, the Callan chart. I don't expect you folks to be able to read it from the back, so don't panic just yet. This is a periodic table that gets put out every year, and the different colors represent Well, I should explain this. Across the top, you have 1996, 97, 98, all the way through to 2015, which is the last completed year. And then going up and down, you've got 1, 2, 3, 4, 5, 6, 10 different asset classes with the different colors, and they're ranked here in the order of performance for each year. So in 1996, the brown one, which happens to be the S&P 500, did best, and the green one down at the bottom, which is the Barclays AGG, the composite bond fund, did worse. And the challenge here is to pick out the pattern. Thank you. That's the point where thank you. I think. Do you want to come up here? He said the pattern is random. It's just chaos. Yeah, you can see the S&P 500 is up at the top. The brown ones, did great in 1996, 97, 98, and then they dropped down. And then in the last 2 years, 2014, 15, they're back up again. If you look at the emerging markets, which is the yellowish things here, they're way down here at the bottom here. They go up to the top for 2003, 4, 5, 6, 7. They had a great run. And then, you think, oh, I'm onto something here. And just about the time you figure you're onto something, they're down at the bottom again. So that, so don't worry about the details. Just, this gentleman said exactly right. It's random. It's chaos. I don't believe there is any way of looking at data like this and making any predictions at all. So even if you know what 2015 is like, or we'll fill it in a month from now and put the 2016 data up there, it doesn't tell you anything about where 2017 is going. I believe it's referenced in the websites at the back. If you just Google Callan chart, you get CALLAN. It comes from a number of different sources. Callan has a financial advisory service, and he's the one that came up with it, whose name is on it. But a lot of different financial companies publish their version of it in different forms, and they use the same technique. They just rank everything and put different colors in. It's fun. It's fun, but don't believe it. Yeah. Okay, looking back in history. You've got to be a little careful about back testing data. You may have a strategy that you think, an algorithm that you think works just fine, and you back test it and you fit it to the curve and everything's great. Be careful of data mining, which is basically looking at past data and tweaking the parameters on your algorithm to fit it, and then using that to project the future. Because when you start projecting the future, you can totally fall off the curve, and it's dangerous. If you're going to back test stuff, I personally, and very few people, I do this, and very few people have the data to go back that far, but unless you go back 15 or 20 years, I think you're at risk for picking up random patterns and just fitting a curve to a random pattern. Be aware that everything is going to revert back to the mean eventually, so that no matter what great theory you have as to why something's way beyond average, it's going to get back to average eventually, and that's life. Looking back at history, you can always find actively managed funds that have outperformed the market in the past. And that includes funds that have outperformed the market for 15 or 20 years. But you still can't bet on them. Remember what I said about Bill Miller? There's a 1 in 30,000 chance, or 30 people per million, or whatever way you want to look at it, that you can beat the market for 15 straight years. You can do searches on various websites today and find funds that have outperformed the market for 20 years. It doesn't mean that the 21st year is not going to be done. In fact, Bill Miller really exemplified this. He had the 15 great years, and it was ended in 2000, and I don't know what year, 2009, whatever it was. 3 or 4 years after his record finally fell apart, he had atrocious returns. Now he has since gotten back to the point where he's gotten his averages back up again, and They're nothing spectacular one way or the other, but after his 15 great years, he had 3 or 4 really, really poor years. The real challenge, of course, is to identify any of these great funds going forward, and I don't think that's possible. You know, and the notion that I hear from most folks that think they have a great strategy is, you know, they say all strategies work until they don't work. And by the time you figure they don't work, it's too late. By the time you figure that, well, the first time it doesn't work, yeah, you say, oh, geez, that's just 1 year. Let's see what next year is like. And you're 2 or 3 years into it before it happens. And by the time you figured out that you got a problem and that it's time to switch, you're already taking a beating. It reminds me of the theory. You folks know the theory that all all odd numbers are prime? 1, yes. 3, yes. 5, yes. 7, yes. 9, experimental error. 11, yes. 13, yes. Same thing happens here. Benjamin Disraeli, I think, was the one who said there are lies, damned lies, and statistics. Just be careful out there. Was it Mark Twain? Thank you. Thank you. I much prefer Mark Twain. That's a better answer. I like that. Okay. What I'm showing here is a slide that should be in neon red or something, because it's just it's opinions. Some of them mine. So be careful, guys. Don't take anything up here as fact. The only thing you take as fact is the first one. Past performance is no guide to future returns. You'll see that on any prospectus or anybody offering to sell anything. You all glance at it and ignore it, and it's in fine print, etc. Harry Domash is a financial journalist in San Francisco, and we've had him speak at a number of our events. One of the last events, he offered the opinion that to beat the market, you have to be able to predict the future. I don't disagree with that. I think it's probably a true statement, but it's an opinion. The problem I have with it is it doesn't go far enough. The Fred Smith version of it is, to beat the market, you have to be able to predict the future better than everyone else. Because if you predict the same future as everybody else, you're going to get the same returns as everybody else. And that's not an easy thing to do. In fact, my personal opinion, again, is that you can't predict the market, but you can prepare for it. And preparing for it means building a diversified portfolio, dull and boring. Diversified portfolio of low-cost index funds. You've heard it all before. You had a question? You prepare for it by building a portfolio, a passive portfolio of low-cost index funds and rebalance diligently. I should get a rubber stamp. Yes. That's the only way that I know to prepare for the future. If you want to be an active investor, I believe you have to convince yourself that you can predict the future. Maybe you can. I can't. I'm no good at predicting the future, so I do it my way. Here we're into another opinion, Fred's folly. All successful investing strategies lead to comparable long-term risk-adjusted returns. I can't prove it, it's just a nice hypothesis, and I happen to believe it. I go beyond that and say here we go again, the rubber stamp. Building a diversified portfolio of cheap index funds is a successful long-term strategy giving the market return. Therefore, you can fill in the blanks yourself. Therefore, all successful long-term strategies lead to the market return, including active strategies. Am I being overly pessimistic here, folks? Do I get any pushback? Doesn't anybody bite on this? Okay, moving on to the real world again. I just want to go back and revisit this. Do we have another question?
So the question is, what exactly is passive investing? One investor buys 2 index funds, a bond fund and a stock fund. The other investor buys 18 sector index funds. Are both of those passive?
The question relates to what exactly is passive investing. Okay. Yeah. If one investor buys two funds, I guess it was an equity fund and a bond fund, and rebalances regularly, that's most certainly passive investing. What about another investor who buys 18 different funds? I guess sector funds were mentioned, and is that passive investing? It can be if he has written up his IPS, his policy statement, to say that he's going to buy 18 sector funds, and he's going to buy them, allocate them in a certain asset allocation, give the percentages for each of them, and he's going to rebalance back to those percentages once a year or on an as-needed basis or whatever. Yes, that could be defined as passive investing. He would get the market return on average for those those group of sectors. I want to just get back to this curve again, showing the active spread and the passive, the narrow passive spread. We've said, I think we understand a little bit better now why the choice of being in the tight spread here for the passive investors and getting the market return, and we understand a little better the risks involved in shooting for higher returns on an active basis and the almost certain result of having some folks be on the other side of that curve. For the winners up here, I keep losing my arrow, for the winners up here, we also have losers down here. So you should not, what just happened? So you should not even shoot for the above average returns unless you understand the risk that you're taking and the not just possible but probable results of falling short on every once in a while and being on the other side of that curve. The last half dozen, 6 or 8 slides, I think will show you reasons why you might want to think carefully before you shoot for the above average returns. Yes, sir. That's a really good question, and thank you.
Why is it getting more than 0?
The question is, why is beating the market considered a definition of success? I think, and then the question is, why not just have a goal of getting more than 0? You're absolutely right. If you have a good financial planner, you should go back again to your PIP and your IPS. And right in there, it should say, amongst other things, not just who you are, but what you need to get. Why are you making these investments in the first place? What do you need to get from it? Do you need to get the market return? Do you need to get to take additional risks and get an above return, even at the risk of occasionally falling short? If, for example, you've not been diligent about saving enough through your working years for retirement, some people may be forced to take extra risk in order to get to hope for the higher return. On the other hand, if you have a nice nest egg and don't need to take that risk, you should not take it. You should define, getting a return, a significantly lower return may be perfectly adequate, and you would put together a much more conservative portfolio. That portfolio might well be 70% fixed income and 20 or 30% equities rather than the other way around. If that will give you the income that you need, that's absolutely what you should do. So I agree. Any other questions? Okay, we'll move on. At the second workshop, we looked at building a diversified portfolio, a passive portfolio, and at that time, because of time limits and all the rest of it, we just used anywhere from 1 to 4 funds, exchange-traded funds. If we had more time, or if you're doing it in practice, you might well go up to 8 or 10 index funds to build a broadly diversified portfolio. But even with just 4 and rebalancing those annually, we put together a portfolio that would grow 10,000 bucks to anywhere from 30 to 60,000 bucks over a 20-year period, give you a compound annual growth rate, a 20-year CAGR of 7 to 10%, and a Sharpe ratio, again 20 years, of 0.6 to 1.0. Those I regard as reference numbers, and I'm throwing them out as a challenge to the active investors who think they can beat it. And what I'd say is, what you got to do is look at a 20-year history and see if in practice over those 20 years, or over the full 20 years, you've been able to come up with a return, a compound annual growth rate, and a Sharpe ratio that beats the numbers that I've shown here for the passive portfolio. I don't want to hear about folks that timed the market just right and got out until the end of 2007 and boy were they brilliant and all the rest of it. I don't want to hear about the folks that made great moves in 1999 or picked great stocks in 2005 or something. Everybody can be brilliant once in a while. The real thing is whatever strategy you're using, what has it done for you over a 20-year period? Do a real measure of what it's done for you. And the easiest way of looking at your 20-year data in practice is to look at your retirement portfolios, because those are the ones that you will have the data on. Most folks, if they have IRAs and 401ks and so on, that'll be your best chance of pulling out 20-year data. But even if you do get the answer back that boy, oh, really was brilliant, and I got 15% per annum or whatever over that time, you then got to ask yourself, how much time did you spend managing it? Is that the time that you enjoyed doing it? Can you survive if you're on vacation somewhere for 3 or 4 weeks in Fiji or in Safari in the Serengeti or somewhere that's got no internet? Are you going to be driving yourself crazy worrying about what's going on back home, or can you relax and not worry about it? Or the bottom line, would you really rather be fishing? Whatever your thing is. Again, I'm not saying that you shouldn't be an active investor. I'm saying if you want to be an active investor, you'd better think about these things, and you'd better convince yourself that, number one, all of the question marks that I've been asking for the last hour, that you can answer them to your satisfaction, and number two, that you enjoy it. I mean, if you're doing it for fun, go ahead, just try not to do too much harm. Try to stick to low cost. Try to stick to low cost funds, even if they are active. Don't go giving somebody 1.5%, 2% for a fund that he promised you is going to be great. Just to put things in perspective, we've got a quick look at some pension funds here. The state and local government funds have the advantage that they can go anywhere. Excuse me. They're not limited in their prospectus to only large cap, blah, 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 blah. But most of them can do anything, including hedge funds. They can invest in private equity, whatever they want. And they've got the resources, for the most part, to research all of this. But their average returns over the past 25 years have been 8.5% per annum. That's okay by my book. It's right bang in the middle of what most passive investors could expect. Future returns, I'm sorry, your question?
What do you mean by go anywhere?
They don't, the question is, what do I mean by a go anywhere diversified portfolio? What I mean there is that they're not constrained to any given, they're not limited to investing only in certain types of funds, or they're not, they're allowed to sell short if they want, or they're allowed to use derivatives if they want. They can use whatever, in general they're not constrained, they can use whatever techniques they think is going to work. They've got a huge broad range with no limits. Go get the results, guys. We don't care how you do it, as long as it's legalized. Question is whether there's a specific category of funds that are considered pension funds. I'm talking mostly about local government funds for their employees. I'm talking about teachers' funds, things like CalPERS. CalPERS is a great example. CalPERS is, I guess, the largest pension fund in the U.S., possibly even probably in the world. And they have hundreds of, a staff of hundreds of sharp PhDs, etc., CFAs, etc., and they're running billions of dollars, so they can spare no expenses on making sure they get it right.
So can individuals invest in
No.
it has to be through the
No, the question is, can individuals invest in pension funds? No, I'm only using the pension funds here as an example of the returns that a professional manager can get with all the resources in the whole world available to them. Another question from the web.
One related question. So assume that the guy on the other side of the trade is in fact smarter than the average guy. Okay. Can the people that have the advantage and the smarter guy beat the market over time?
The question from the web is, assuming the guy on the other end of the trade is in fact a smarter investor, can he beat the market over time? The answer to that in my mind is absolutely he can beat the market from time to time, but I would challenge him to do it on a consistent basis over a 20-year period. I don't know of anybody out there that claims to be able to consistently beat the market on a long-term basis. I think some may claim it, but very few have been able to prove it. Yeah, exactly. A lot of the funds are projecting lower future returns, and I'm assuming that that's because the environment is different over the next 20 or 30 years than over the past. The big difference is the bonds market. The bonds, it's been a real bull market for bonds going back to the, I guess, Carter years when interest rates were up in the high teens. They've been on average falling ever since, which is very bullish for the fixed income. And we've hit bottom a few years ago, and most folks, I think, would agree we're about to turn the corner and start heading back up, and that could be for the next 10, 20, 30 years. Again, who knows how long. But if the fixed income environment has changed drastically, I suspect that's the reason why the pension funds are lowering their projections for the future returns. CalPERS, I saw recently, I think it was last week in the paper, where they were looking at a reduction from 7.5% down as low as 6.2% for the future. It makes a big difference. I mean, this number is used in discounting their liabilities for the future. They have to make pension payments, into the dim and distant future. If they use this number to discount all those numbers back to the net present value, the lower that rate goes, the more people have to kick in, in the contributions today to get their portfolio up to a reasonable percentage of their total liability, so they don't lower it lightly. And in fact, the unions and everybody else pushes back against them, but they're looking at picking a rate somewhat lower than 7.5%, and it could be as low as, I've heard 6.2 is the lowest. It may wind up around 6.8. The other thing that CalPERS is doing is switching, not just CalPERS, but a lot of the other large funds as well, is switching significant chunks of their portfolio over to a passive index strategy. CalPERS, I believe, a year and a half ago, laid off a whole bunch of their high-priced analysts and cut back on the percentage that they were allocating to the active strategies and moving a major portion of their portfolio over to the passive end. Yes, sir.
So if what you just described with pension funds continues on a large scale and the 70-30 flips around, what kind of world will we have?
Question is, what kind of world will we have if the large pension funds flip around from what, let's just say, used to be a 70 equity, 30 fixed income to the other way around.
30 active, 70.
Oh, I'm sorry, 70 active, 30 passive. The question of what kind of a world will that lead us to? There is some concern, which I think is at the moment is grossly overrated, that if the 30% passive continues to grow, that eventually, we may get more passive investors out there, or people following a passive strategy, including the big guys, than the active ones. What will that do to the market? The market will become less efficient as we get there, because there'll be fewer folks trading it, and you'll reach an equilibrium eventually, but I don't know where the equilibrium will be. In practice, I don't think we're anywhere close to that yet. It could be decades before the passive segment of the market gets large enough to affect anything that we've said tonight.
So you're essentially saying you'll never get it?
Probably not in my lifetime or yours. And you're absolutely right. I think it's a true statement. We never will, because before we can actually get there, the inefficiency has to become great enough and show up enough that it becomes worthwhile being an active investor. It's a sort of a self-correcting, there's an equilibrium there somewhat. Okay, so who should be an active investor? I hear laughter out there, and I'm not sure that was the reaction that I anticipated. You should be an active investor if you're smarter than the average guy, you have access to better data, do you have more resources available, better, higher, faster computers, etc. That brings up a point. There are a number of folks who are into, I guess it's front running in one form or another, who want a whole bank of high-speed computers as close as they can get to Wall Street, because the nanosecond difference can make a difference in their trades. And real estate close to Wall Street is at a premium, just so that folks can run their high-speed computers a half nanosecond faster than the guys across in New Jersey somewhere. That's the kind of edge that you need, that they figure they need. But at the more individual level, you really have to argue that it's tough to have better data than the pros out there. They can afford to pay tens of thousands of dollars for databases that's just not available to the rest of us. You have to be prepared to be on the wrong side of the trade every once in a while. In other words, there'll be times when you're below market as well as above market, and you got to be prepared for that. Don't just assume that you have this great strategy that's going to always bring you out on the fat side of the curve, on the plus side of the curve. If you enjoy the challenge, it's okay. Some folks might prefer to do this than to do Sudoku or the Times crossword puzzle or whatever on weekends. Again, just be careful you don't do yourself any harm, and the easiest way to avoid hurting yourself badly is to stick with low-cost ways of doing it. If you keep the cost down, you won't go too far wrong. You don't mind giving up your evenings and weekends, because that's what it takes. And again, we get back to Dirty Harry. You're going to be lucky today. You should be a passive investor. If you're comfortable earning the market return, because that's what you're going to get, good, bad, or indifferent. In good years you get it, and in bad years you get it. You're happy knowing that your strategy beats 60 to 80% of all the other investors out there. No. I mean, yeah, you're right. But you're right if you exclude costs. If you put the costs in, it's asymmetrical. It's not totally symmetrical. Can you stay the course when you have a downturn? You test the fortitude to stick with it and not panic when in 2008. Again, go back and look what you actually did in 2008. Did you have the guts to do nothing? Just sit and watch it happen? apart from wondering what just happened. If you enjoy spending your weekends doing other stuff, I mean, who needs to be on a computer all weekend? If you are perfectly comfortable going on a 3-week safari and never hearing about what's going on in the real world, never caring what's going on. Elephants beat bulls and bears every time in my life. My advice is think boring. Think big. Boring is good. Think big. For those who can't decide, I brought this up earlier. You can use a core and explore compromise. You can build up a core with, say, 75–80% of your portfolio using a passive index strategy, and that's your real investment. And then if you really want to roll the dice, a little bit, you can do 20%, satellites out there, a few percent in this, a few percent in that, where you're taking an active strategy, and you need to, I would suggest you track your returns carefully, and again, make sure over a long-term basis that any fun you're having from it is paid for without incurring too many costs. Track the performance each way and be honest with yourself. I mean, the big thing that you give up in the passive investing is that you can never be a hero at a cocktail party. You've got nothing to brag about. It's dull and boring. You don't get to go in there and be, brag about the great killing you made. But you don't have to go in and hang your head in shame either. Since this is the last workshop on investing, I wanted to wrap up with a recap of the process. Step one, we get back to the PIP. Know thyself. Before you do any invest, I think this may be missing in some of the handouts, I'm sorry. The slides will be available on the website in a couple of days, so if you're missing stuff, it will be available. The question, one of the questions we asked way back was if somebody came to you and said they got, great Aunt Mary left them $100,000. They say, they ask you, what should I do? What's the best thing to invest it in? There are probably thousands of wrong answers and only one right answer. And the only right answer is the 2-word phrase you all know: it depends. And what does it depend on? It depends on who you are, what your time frame is, what your risk tolerance is, what your tax status is, etc., etc. It's the stuff that goes into the PIP. So step number one is if you haven't done it, take a few minutes, write down your PIP and put it in your All About Me folder. Step number two is the IPS, the policy statement. You've got to decide what asset classes you want to work with in your portfolio. And you might say, well, I want to have a certain amount of, I obviously need a certain amount of fixed income. You almost certainly wouldn't have that. Your equities, you might figure are going to be, you might split into large cap and small cap. You might have some growth equities. You might have some value. You might have some international. You might even have some emerging markets. But define what asset classes you want to work with. Define the asset allocation for each of them. And again, you're going to go back to your PIP and your risk tolerance, and you're saying, well, I think based on my age and my projections for what I need for the future and my risk tolerance and so on, I think I want 35% fixed income and 65% equities that will cover me through age 100 or whatever you want to run your plan out to. So you need to carefully figure your strategic asset allocation. You need to define if you're going to follow, put in writing whether you're going to follow a passive plan or an active plan. No hiding behind the pillar on this thing. I mean, be honest with yourself. If you're going to commit to doing passive investing, after you've got your asset allocation figured out, you should document how often you're going to do your rebalancing. I would suggest annually is probably a good start. There's data that shows that doing it any more frequently than that probably doesn't do any good and may even hurt. You could go to 2 years if you wanted, but annually is a nice compromise. The other thing you can do instead of doing it annually, it's a little more work, is to look at it monthly and decide if your current allocation is within a certain percentage of your strategic allocation. You might say that if it's closer than plus or minus 10%, you leave it be. For example, if you'd figured that you want your large cap value to be 20%, and you look at it and it's currently 19%, you say, okay, it's close enough, I'm not going to do it. If it's within the 18 to 22 range, you might say it's okay. If it's sitting at 17%, you say, oops, that's shifted significantly now, I got to go in and do some rebalance. Nothing magic about the plus or minus 10%. For some people that might trigger rebalancing more often than you want. You might go with the plus or minus 15% range or even 20%. But all of this should be defined in your IPS. If you're going to go with an active strategy, write it down. If it isn't written down, it never happened. Write down not just what your strategy is. I mean, if you can't write it down, then you don't have a strategy. It's real clear. You should define the rules that you're setting up for yourself as to when to make a trade, when not to make a trade, whether you're allowed to sell stuff short or use derivatives, etc., etc. But whatever your strategy is should be written in your IPS. That's actually the hard part. The rest of it's fairly easy. Selecting specific securities. When you're doing the asset allocation or defining your asset classes, don't get down to the nitty-gritty specific funds at that point, because they change, and the Schwab S&P 500 may be better than the Vanguard, may be cheaper than the Vanguard tomorrow, whereas it's different today. So you may want to switch some of them. Just say that you want a large cap, blend fund or whatever it is. But when you're making the specific securities, at that point, step 3, you need to pick out the exact mutual funds or ETFs that you're going to use, or individual stocks and bonds, whatever, REITs, whatever's on the list. Step 4, implement it, make the purchases. And then step 5, now that you have a portfolio and it's off and running, you've got to review it on a regular basis, and regular means different things to different people. If it's a passive strategy, again, I'd suggest reviewing it annually is probably adequate, unless your IPS says that you're going to use a bracket. Review it monthly or quarterly and use the bracket limits. For an active strategy, you want to monitor it and make whatever trades you've defined in the IPS. And frankly, you're on your own. There's nothing I can do to help you. Nothing I can say here can help you on it. It's whatever you define for yourself in the IPS. But it's important to do the IPS on a nice, calm environment where you can think through what you're doing, why you're doing it, and really get behind it. Because if you wait until you're doing it with the 10% or 20% crash in front of you or right behind you, and you're wondering, now what do I do? It's too late to start thinking deep thoughts. Before next month's workshop, what I would suggest is that everybody had gone back. I'd suggested in the previous workshop that people go back and reevaluate your PIP and make sure that it's still something that you feel comfortable with. At this point, I suggest you reevaluate your IPS, because I'm not sure if anything that I've said tonight in any way changes. Well, I probably haven't changed too many people's minds, but at least I hope that folks will go home and think about it and look at what you had put down previously for your IPS and see if you want to make any changes to it. The other thing that you might want to look at is going back over your retirement accounts, like we said before, and looking at the 20-year risk and return, calculate the Sharpe ratio for those over on a long-term basis, and see if you're happy with the results compared to the results that I published a few slides back for the diversified portfolios. Next month, as I said, this is the last of the investing workshops. So next month we're going to be moving on to retirement planning. And do we have a question?
Yeah, well. Okay, so one person asked about, there are ETFs out there that implement a specific discipline. So for example, dividend achievers go after high dividend stocks, right? And so on. So if you use those ETFs for your strategy, is that considered passive? Is that reasonable?
Okay. Question relates to some of the exchange-traded funds that have a certain goal, like perhaps high dividend achievers or something like that. And the question really is, can that be considered passive investing? I would say not, because by definition, the high dividend stocks are a subset of a larger index, and you're basically carving out something that's a little different to the index. And I think what you're getting may well do better under some circumstances, but you've got to be prepared to do worse. The high dividends may well be out of favor under some conditions. It may not necessarily happen right away, but you do run the risk of that happening. So I would say no, that's not a passive approach. Any other questions here? Yes, sir.
I've got an ETF that I want to sell after the first of the year, but it's one of those ETFs that doesn't trade very much. It's not very big. It's supposed to be some way that you put your order in as a non-market order, some kind of a weird other kind of an order.
Okay.
Get away from the risk of a big spread.
Okay. The question relates to by a gentleman who says he got an ETF that he wants to sell at the, I think it was at the end of this, or next year. Yeah, first suggestion I would have is you may want to consider selling it before the dividend is announced, so that you don't have to pay the taxes on the dividend. But that's a separate issue. The question is there any way of putting in a sell order other than a market order? Because with the market order, you're at the mercy of the market for what price you get. And if something occurs to drop the market at the time you put the order in, you may be stuck with it. Yes, you can put in a limit order, which basically says sell so many shares at such and such a price. You can actually name the price that you're willing to. There'll be a limit order. Sell X number of shares of such and such an ETF at such and such a price. Now the risk of doing that is that it may never get up to that price. You have to be careful picking the price. With a market order, you're guaranteed to sell the shares, but you're not guaranteed the price. With a limit order, if the shares sell, you will get the price, but the shares may not sell. So there are pros and cons. But yes, you can put in a limit order, and if you're doing this online, again with whatever broker you use, you'll see on the page where you're making the sell, there'll be an opportunity where you can pick whether you sell at market or whether you use a limit order, and if you're using a limit order, at what price you're prepared to accept. And if it hits that price or anything better than that price, you will sell. If it doesn't hit the price, you don't. Any other questions before we leave investing? I think this is my last slide or close to it. Next month we're going to be talking about the first of our 3 workshops on retirement. And we're going to be looking at retirement planning, which is the accumulation phase. I'll try to give you strong incentives to start saving early, which for the retirees in the room are the done deal probably. But for your kids and grandkids, you can pass on the wisdom. I'm going to be talking about the various types of accounts, the IRAs, Roth IRAs, 401ks, 403bs, and all of these. and looking at the different attributes of them, and we're going to be looking at ways to manage your accounts. So that's what's on the books for next month. I've given you some light reading material here, which again you may not be able to read from the back of the room, but it's hopefully be legible in your slides or in the printout. This is the first thing. Well, yes, we have a question.
Are the references to the AI journal available online? In other words, if you go to the AI website, can you find back issues and read articles, etc.?
As a member? Yeah, the question relates to whether you can find the AAII references online as a member. Yes, as a member, I believe you can search it. I'm not sure how far back. Does anybody at the back of the room know how far back you can go? They have a fairly good archive. I don't happen to know how far back you can go, but I suspect most of these will be available, yes. There's some books on here that are, fairly, some of the old standards. Winning the Loser's Game by Charles Ellis, Random Walk Down Wall Street by Burton. These are fairly light reading, but they're good reading. I like the philosophy. Useful websites. AAII.com, the national organization back in Chicago. Our local Silicon Valley chapter has a whole bunch of presentations from the past events on there. You may find stuff that's of interest. I'd already mentioned the Santa Clara County Library. If you go on the website and you go on the business and money, click on that, you have access to Morningstar, Standard & Poor's, Value Line, and a bunch of other neat stuff. Bogleheads are kind of like it's a blog and it's very informal, but same thing goes through the Oblivious Investor and Mike Piper and also Rick Ferry for that matter. Some good light reading if you want to go on there. And somebody had asked about the Callan charts. This may not be the best website for it because I think they may have you register on that, and I'm not sure whether it's easily available. But again, if you Google Callan chart, it should come up. I couldn't resist putting in, just summing up the last few months. I couldn't resist putting in the Motley Fool's view. Every 5 to 7 years, people forget that recessions happen every 5 to 7 years. You're twice as biased as you think. 4 times if you disagree. Read more history and fewer forecasts. I like John Maynard Keynes. The stock market can stay irrational longer than you can stay solvent. Bill Sharp, are you smarter than the average professional investor? Probably not. That's what we were talking about earlier on, folks. The other thing is, investors were probably better informed 20 years ago before there was when there was 90% less financial news. The financial news, I think, is it's a lot of it you're getting swamped with a lot. Talking heads aren't giving you news; they're giving you garbage. Somebody asked the question: if you have to talk for 24 hours a day, 7 days a week, think of all the things you'd have to make up. Well, think of that next time you're looking at some of these talking heads. And finally, we end up with my favorite, Scott Adams. You can beat the market averages by doing your own stock research. So you believe every investor can beat the average by reading the same information? Makes you wonder why they don't do it. Again, just what we're talking about. Any final questions? Anything anybody wants to talk about? Okay, folks. Thank you for your attention.